Welcome to Purchase and Profits. I'm Seth Ferguson, and let's talk some real estate. Our guest today owns over 2,000 units across the U.S. worth over $250 million. She started her career as a commercial real estate lawyer, then worked as a property manager for one of Israel's most prominent oil and gas companies. She is an author for Forbes, writes a weekly blog, and is the host of the podcast, That Really Happened, Unbelievable Real Estate Stories. Ellie Perlman is founder and CEO of Blue Lake Capital, a real estate investment firm specializing in multifamily investments. Ellie, welcome to Purchase to Profits. It's great to have you on the show.
Hi, Seth. It's great to be here. Thank you for having me.
Yeah, I'm really excited to talk about your story. You've got a really good one, and I'm looking forward to you sharing that with all of our viewers. So just to get started, do you want to give us a little bit of a background on what you were doing before real estate even entered your life?
I can't really remember when that happened because I was always involved in real estate in one way or another. Right in college, when I started college, I went to law school, and my main focus was real estate and law. So I started, even then I was involved in real estate. I worked as a commercial real estate lawyer for several years, and when I was working on huge deals, they were mainly development deals. I started feeling that I was in the wrong place, that I actually wanted to be my clients, and that realization was the pushed me towards making this critical decision to actually move out of law and into property management, which is what I've done after that. And some people thought I went crazy. Why are you becoming a property manager? You worked so hard to get to law school. You're working for a very large firm. But I've always liked the action. I've always wanted to be where decisions are being made. And I remember looking at my clients, and they were traveling all over the world to look for new sites to develop real estate, and deciding where the next mall is going to be built, where the next apartment building is going to be built. And I was envious. I wanted to be them. I've done some property management for a few years. And then I realized that I wanted to switch to investing, but I understood that I needed to know more about business and real estate. And all that was in Israel. So I've decided to move to the US. I wanted to go to a school that specialized in entrepreneurship, because I think real estate in its core is entrepreneurial 1,000%. And I was lucky enough to get into MIT. And MIT also has, I don't know if it's very well known, but they have a really strong real estate program. And I graduated with an MBA, and I also took classes in real estate. Then moved from Boston to the warmest place I could find in the U.S., and that's why I landed here in California.
Nice. And, you mentioned that you wanted to be your clients. And I think this is something that comes up with almost all of the people I speak with. I know even with myself, I started on the brokerage side of things. And then I realized that it's the people who are doing the deals, not the people selling them, that truly get wealthy. And You found the exact same thing, doing the commercial legal side. That's so interesting because it comes up time and time again. So with MIT, did you find that really worthwhile in what you're doing now?
Absolutely. It's not really related directly to what I do, but learning about how businesses work, how you market yourself, how to build an operations, that knowledge is applicable to any business. And I'm definitely a different person now because I think differently. I don't look at a deal and I say, oh, you know what? I just want to get through that deal. I'm looking at everything as a whole. I'm looking at it as a business. And I'm asking, from the first day that I got into real estate investing, I was asking, how can I build this as a business? How can I scale it? So it took me more time than others to start investing because I was working on building systems that will scale and work. And that's one aspect. the other aspect was that my network has grown tremendously, especially since someone who's, coming from Israel, from outside the US, and in the syndication business, relationships is everything. And meeting new investors is key. And I've built a really, really good network at MIT, and the people who graduated with me, when I was starting investing in real estate, I was probably making a lot less than that they were. But they're the type of people that are eligible to invest in real estate. They're accredited investors. They have very good job, usually in tech. But they're not going to quit their job like me and go and invest in real estate. So they're great candidates for real estate investing. And I think in those two aspects, MIT was, very instrumental and very, very key to my success.
For sure. So if somebody's out there thinking about getting into real estate, I know lots of people enter real estate as almost like an amateur. They don't think about it as a business. Would you suggest somebody go and take some business training to learn about scale and systems?
I think that can definitely set, some investors apart. I think first and foremost, I'm not an investor. I'm a business owner. And my goal is to scale. A real estate investor could be someone who owns one single family home that he or she is renting them out. And a business owner is someone who owns thousands of units, who employs people, who has systems and a solid marketing plan, and looking into the growth and the expenses and trying to scale and improve every day. So that, I think, what separates business owners from real estate investors, and definitely learning that. You don't have to go to school to learn that. You can shadow someone or work for someone who does that and learn it this way. There are so many ways to learn, how to scale a real estate business.
For sure. And I think too, you end up with a better product for the consumer once you build those systems, because now you have a repeatable process that you can fine tune. So I think, whenever you have a solid system that you've built, as long as you stay on that track, you're going to find, that the product you're able to offer your investors and even the tenants is going to be a lot more superior.
Absolutely.
So how long have you been in the States then? When did you?
I moved here in the summer of 2014.
2014. Okay.
Yeah.
And did you make a real estate goal at that time? Is that when you said, I'm going to jump right into syndication? Is that when it happened?
No, this decision came after that. When I moved here, I realized that I wanted to learn more about business and entrepreneurship, and I knew I wanted to go back to real estate, but it wasn't clear for me how. And me being the nerd that I am, I took a piece of paper and I wrote down, okay, real estate is the goal. Now, there's so many ways to become a real estate investor. I was going through the list of, do I want to do fix and flips? Do I want to do buy and hold? And if buy and hold, then single family homes or small multifamilies. And I started to read and learn more about those type of investments. And I knew what my goal was, where I want to be in 10 years and 15 years from now. And to get to that goal, I realized that buying single family homes is going to be a very tough and not so pleasant path for me, because the average cash flow from a single family home is about $275 throughout the US. Some markets have negative cash flow. Some of them have $500 or $700 cash flow per month. And for me, doing all that for such little money, it didn't make sense. And I figured out that I needed to buy 10,000 single family homes in a year to get to where I want to get to. And
yeah, that's a lot of houses.
Yeah, exactly. So I thought, okay, if I need 10,000 units or 10,000 homes, there's got to be a better way to scale, because I was always thinking about scaling. And that's how I realized that multifamily is the way to go. You enjoy economy of scale. You have you're able to do one deal, and it takes more time than to find one single, family home, but you can close on 20, 50, 100, 300 doors in one transaction. And it's a lot more sustainable than finding 300 homes and buying them in 1 year.
For sure. So when you were thinking about that, did you have did you say I want to own 5,000 units, or did you say I want to earn this much a month, or did you have a total portfolio value in mind when you were doing your goal? How did you approach that?
My goal was to own 1,000 units in my first year, and I can tell you that I didn't get there, but I was pretty close. So once I had a goal, a certain number, I reversed engineered, and I said, okay, if I want to have 1,000 units in my first year, how long does it take to? What's the average deal size that I'm looking at, which was around 250 units? How long does it take to close one deal? And then I realized how many deals I need to analyze every day in order to be able to close 1,000 per year. Um, One of the reasons why I didn't get there was because it's deals are harder to find, and I made the conscious decision to go a little bit slower and not to take deals that don't make sense just to fill up the quota of 1,000 doors. But reverse engineering was really helpful for me to understand how many deals I need to look at and analyze every day. And then I understood I can't do it by myself. And that's why I hired people to help me do that, so I can have more time meeting with investors and interviewing for, running my own podcast and being on podcasts like this one, and outsource the other function of my business that other people can do. And of course, I oversee everything. But knowing the goal and then reverse engineering it to the daily tasks of what I need to do in order to get there was very helpful for me to understand if I'm on track.
For sure. And how often do you reassess your goals? Do you do it every quarter or every year? How do you run it?
Um, by the end of each year, I do a goal reassessment, but I'm trying not to stick only to that framework. If I feel that the market is changing, or if something in my own personal life that changes, then I feel that I need to reassess the goals. I think it's important to understand, not to be so strict with your goals if there are other things that change around you, because you want to be persistent, but you also don't want to be too stubborn and ignore what's happening. And that's why, understanding what's happening in the market right now, there are deals, but a lot of them are not good deals. And I made the decision, okay, it's not going to be 1,000 units for per year. But I know that I can sleep at night knowing that my investors' money, they're safe and their investments are safe. And it's okay if I didn't make that goal, because there are other things that are more important, like trust and self-fulfillment, which comes from knowing that you're helping people grow their money. And it's not necessarily that number of doors per year.
Yeah, and I think that really shows the maturity that you have in terms of your investment portfolio, because you're building that strong foundation. Because if you're just going out there buying whatever deal just to get your unit quota, at some point, if there's a big market shift, that's all going to come crumbling down. So that's really good to hear that you're actually using the way the market is to move you whichever way in terms of your acquisition goals. So that's great. So what key people have you brought on your team? You mentioned that you have a team that allows you to do a lot now. What key people do you have right now?
So I have my team is pretty lean, which is something that I learned at MIT, how to run a business with a not hiring that many people, with a lean team.
Yeah.
I have a social media manager, and she takes care of making sure that my brand is visible and is online at all times as much as possible. And I have two underwriters, and I've divided the markets that I'm active in based, to both of them. So they're sourcing deals. They're out there finding the deals, running the numbers, and once the numbers look good, then I'm become involved in the process. I review everything, ask questions, and guide them to get better answers. But that way, if there are deals that don't make sense because the price is too high and the returns are too low, and only to get the deal I need to offer a price that will only make sense if my assumptions are aggressive, those deals, at least I don't spend time sitting down hours and hours a day running those numbers, because I have the people to do that, and they're kind of the gatekeepers for me. So they bring deals that have potential, so I can take a look at it and lead it from there. Besides that, I also I have a team of, but so those are my employees, and then I'm outsourcing some of the functions. Of course, editing my podcast, and I have a copywriter also that I'm guiding the copywriter what I want to write about, and I get help from him because I also manage a blog. So I'm reading everything, I'm improving everything, and I have to say, before I hired anybody, I did all of that by myself, which was very difficult, but I'm very, very grateful I did that, because only after I was doing everything, I knew what to look for in my employees, and I know when I'm reviewing their work, I know what to pay attention to. So, for instance, if I'm looking at a deal with my underwriter, I know to pay attention to their reversion cap, the exit cap. What is the cap rate that they've used? Or if if right now, if the T12, the trailing 12, the profit and loss of statement of the last 12 months, if the vacancy is 4%, when we're renovating the units, what vacancy are we using? What are the assumptions? Should it be 5, 7, 8? Without running the numbers myself for 6 months, I wouldn't have known to ask those questions, and understand, why did you pick, okay, higher vacancy rate because we're renovating units, and some of them will have down units for a month or so. That makes sense. But how much? Is 7 reasonable? Is 5? Is 9? So understanding that you need to look at the competition and understand the market, understand how the in a combination with how the property was performing. So actually doing everything was very helpful for me to understand how to build and how to scale the business.
For sure. And I'm going to take a guess here. Tell me if I'm right, but did your productivity at least double when you brought your team on board?
More than double.
Yeah.
More than doubled. It's I have so much more time to do the things that are directly related to, directly increase the profitability of my business. The way I see it, I outsource, doesn't matter. I mean, for employees or other companies that help me, do some of the functions that I need them to do. I outsource those tasks that are not have to be done by me, because some things nobody else can do. I'm the face of the company. And when people invest, they want to know who they invest with. So I have a monthly meetup for passive investors here in Santa Monica. No, I can't hire someone to run it for me. People want to see who they're investing with. I can't hire someone to promote my brand and be on podcasts or interview other people. So I found those high value, high profit tasks that only I can do because I'm the face of the company, and everything else I outsource or hire to do. And my productivity has improved significantly. I know that other people are partnering up, and they divide and conquer that way. So one partner can focus on the social media and money raising, and one partner can bring the deal and analyze it and walk the properties. So any way you want it, I think it's key not to try and do it on your own. And you're absolutely right. My productivity, has increased tremendously.
Yeah, no, that's great to hear. So we were talking a little bit about underwriting deals and your experience with that. So let's get into the deal that that game changer deal that changed things up for you. Do you want to tell us a little bit about that deal?
Yeah, absolutely. So I was one of the markets that I'm focused on. I was looking at several deals, and one really stood out as a deal in a very, very strong location, a beautiful property, and a property that was about that has a really, really good value add potential,
Okay,
which means
what
that
city was it in?
it was a Dallas in
Dallas.
the
Okay,
Dallas Fort Worth area.
gotcha. Okay,
And when I say value add potential, I mean that there was a true potential to to renovate the units and increase rents, and by that increase the value of the property. Um, and I was competing for the deal with other buyers. And when you submit offers, usually the strongest and the highest offers make it to the second round that is called best and final. And I got to the best and final round, and it was my company and two or three other companies, and we made it to the best and final. I flew when I heard that I was in the best and final. That was 9:30 or 10 a.m. my time, and an hour and a half later, I was on a plane going to see the property because I don't walk every property, only
yeah,
those that I actually, make it to the second round. Um, and I walked the property. I had the next day I had a conversation with the seller and went really well. And I got a call from the broker later that afternoon that said, "Listen, it's down to you and another team." And by the end of the day, I realized that the other team got the deal. And I put a lot of effort and a lot of time and research in finding this deal and analyzing it and walking it with my property manager. Um, and I was a little bummed about it. I mean, I lost a good deal, and I understood that. Um, but I've decided, I like this deal so much, I don't want it to be the end of it, the end of the story for me. Um, and I ended up partnering with the company that actually got the deal. And I was able to get on the deal. And I mean, the deal, I mean, it's been doing pretty well so far.
yeah, that's great. And I think even though you initially lost the deal, I think you did a lot of things right. Like you were aggressive, you got on the plane right away and
Yeah.
and went out there, and not a lot of people would do that. So I think that sets you apart. What other things came into your strategy for trying to win that deal once you found out you were in competition? What sort of other things were you trying to do to set yourself apart?
So the main thing that I see that I don't see many investors do is communicate with the brokers and let them know why you made certain decisions. So um, when I offer a certain price, I actually I communicate to the broker and I say, hey, I know that the whisper price was X. I can offer X minus one, and this is why. And then lay out and show them why you got to that number, so they don't think you're trying to lowball them. um, and they see that you're doing a thorough job with analyzing the deal. And that's what I did for that deal. And I said, this is how I got to the price. Um, Explain what are your minimum criteria when it comes to the returns. How did you get to those returns, and why you can afford a certain price. And that was part of the strategy. Also, of course, be there, walk the property, ask the right questions. And I can tell you that that was a great way for me to build a relationship with those brokers. Actually, last night I got an email from one of the brokers on that deal that said, "We appreciate your efforts so far. We've seen that you've been working hard on trying to get a deal. we have some deals that I'm coming online next year. We would like to set up a call with you and see if we can get them for you off market.
Perfect.
If
That's
you'd
great.
be interested. So all those things, I might have initially lost the deal, but I got back on it. I actually got the deal, only in a different version with other partners that I trust. So I was totally fine with that. And now I have an option to discuss off-market opportunities before everyone else, because the way that I operated I was able to build trust with the brokers.
Oh, that's awesome. So when you first saw the deal, what jumped out on the paper to you? Was it the location? Was it the projected returns? What was the big blinking red light that brought you to it?
More like a blinking green light.
Oh yeah, yeah, green light. Yeah.
I think it's not really one thing. It's a combination. So I saw, first of all, I looked at the returns, at the IRR returns, in combination with the vintage. So if you have an older property in the 70s or in the 80s, usually I would expect the higher return. With a nice property, I mean, the property was beautiful, 16% IRR, and was 2000. The vintage was 2001, which is relatively new to value add deals. And that combination of how beautiful the property was, which means it's not only appealing to me, it's going to appeal to other tenants. That combination with good returns, and solid cash on cash returns, that was the first thing that I saw, that I was, I understood that could be a good deal. Then digging a little bit more into it, I understood that the entire property, the property was not renovated, even though it looked beautiful. And two properties nearby were making a lot over $300 more in rent per unit because their interiors are nicer. And that's when it clicked for me, when I understood, wait a minute, I can do the same. My property looks a lot better on the outside, but they're charging more because their interiors are nicer. This is an easier fix. So that's when it clicked for me. And the last thing was, when I was actually driving there, in the area, I realized how much potential there was there, because in terms of the location, in terms of the other projects that are being built right now around it, I understood right away that this area is going to be worth a lot more in 2, 3, 5, and 7 years from now.
That's great. So what's your you've recently closed on this one. What's your exit plan looking like? Are you projecting like a 7-year hold, or what's your plan with it?
Yeah, a 7-year hold. I have to say that usually I would look at a 5-year hold. In this deal, in order to make the returns, 7-year hold made more sense.
Yeah.
But we're going to try and sell it before that. So we're going to be done with the renovation in about 18 to 24 months. And we're going to test the market. If it makes sense to sell it after 3 years and we're still going to make the returns that we projected, then there's no real reason to hold it for 7 years. If we'll be able to make it after 4 or 5 years, we'll do it. But just to be safe, just to be, on the safe side, 7 years is what we were projecting.
For sure. And when you mentioned that you partnered with the eventual winner of the offer process. Did you have any challenges when you were creating that agreement between the two of you?
The main challenge was, for me, just to make the decision, if I want to go with that partner. And it was actually not a challenge, because I knew him for over a year at that point. It wasn't a new partner for me. I don't think there was any specific challenge. The agreement was pretty straightforward, but I think the main thing was, because I knew that person, I knew that company, then it went a lot smoother than it should have been, because I usually don't partner with groups that I don't know, with teams that I don't know. So knowing them and knowing their track record was very helpful. So there was actually no real challenge.
No, that's good to hear. And I think when you have a partnership, both sides are going to bring something a little bit different to the table. And if you can find those complementary strengths, it usually turns out really well, as long as your interests are aligned. And I think in this
Yeah.
situation, they definitely are.
Yeah.
Um, so in terms of how this deal, how you profited from the deal, you're still inside the deal. You're still doing your value add. Can you explain a little bit, if somebody doesn't know how a syndicator makes their money? Can you explain how you profited so far?
Yeah, absolutely. So syndicators they make money by receiving fees and also an equity split. So um, usually there's around 2% acquisitions fee, which is paid when we close the deal. So that's something that we've profited from, and it's 2% from the price, obviously. And then the other part of the fees, which we haven't started receiving yet, is the asset management fee, which is 2%, usually 1 to 2%. And that's being paid from the profit, from the rents. We had a preferred return on this deal of 8%, which means that we're only going to get our asset management fee after investors are being paid 8%. And this is something that if there are any passive investors out there, make sure that you have a solid preferred returns, because that means that it incentivizes the syndicator to work harder, because they're not going to get paid. They're not going to get their asset management fees unless there's some meat on the bone after they paid the preferred return. So the first 8% every year has to go to the investors. And then we also have disposition fee. So when we do sell the property, we also receive a fee from those proceeds. Um, and then in addition to the fees, we also have um, an equity split, which is 70-30. So basically up to a certain point, the limited partners, which are the passive investors, they receive 70% of the profits, and the syndicator receives 30%. And after a certain return, it can either be the same throughout the entire investment, or it can change after you hit a certain hurdle of 13, 14, 15% IRR. Then the equity split can change to 60-40 or 50-50. It really depends on the deal.
Yeah, and if somebody's not familiar, they may hear terms like waterfalls, and that's basically what you're explaining, where it changes. Now, I think, correct me if I'm wrong, but I would assume that your equity portion is going to be the biggest earner for you once you exit the deal.
Absolutely.
Yeah, yeah,
Mhm.
especially once you were describing, the location, the value add, the other drivers in that market, and I think as an investor too, like that's the cash flow and the fees during the hold period. It's okay, but the real gravy is at the end when you exit the deal.
Yeah, absolutely. And that's the beauty in multifamily. I always say that unlike single family homes, when you buy a single family home and you want to sell it, then the value of the property it somewhat is due to renovation, or thanks to the renovation, but a big portion of it is also determined by how much the other similar homes in the area are being sold for. And when it comes to multifamily, if you have two identical buildings in the same area, but one of them is making income that is higher than the other, that building is gonna be worth a lot more, and that owner is going to be able to sell it for a lot higher price than the other identical building. And that's because we're using cap rates, and cap rates are the net operating income. So basically what you have left after all expenses are being paid, before you pay any payments on the debt. And so it's basically the cap rate is the net operating income over the purchase price. So once the income is higher, that means that you can sell it for a higher price because the cap rate should be the same for those two identical buildings. And that's the key here. And that's what's so attractive in value add deals. You're able to force appreciation. You're able to increase the rents, improve the bottom line. And when, and then when you sell, you can sell it for a lot higher price than other properties in the area. And that's where you can make most of your money.
For sure. So, right now you're controlling about 250 million-ish worth of real estate. How has you getting into syndication changed your life and your financial situation?
In terms of how that changed my life, I can tell you that I'm a lot busier than I was before I started it. I used to work in tech, and that was a very comfortable six-figure job that I got bored pretty quickly with. So, it changed my life in the way that I live, breathe, and walk and talk real estate. That's my entire being. That's my whole life. And I think that my interaction, actually, surprisingly enough, my interaction with people has changed because everyone is interested in real estate. Everyone wants to learn about real estate. And that opened up a lot of opportunities for me to meet new people. Financially, I mean, obviously it's been really, really great.
Yeah, no, that's good to hear. And you're not really working for a paycheck. You're working to acquire other assets. And anybody who follows that rich dad, poor dad, example, well, over the long term, they'll really do well. So, Ellie, I just want to thank you very much for sharing your success story today with us. So, where can people find you? I know you have a podcast of your own, and you write the blog. Where can we find that?
Yeah, so you can find my weekly blog and my podcast at ellieperlman.com. And you can also Google Ellie Perlman and you'll see it. My podcast is called Unbelievable Real Estate Stories, and you can find them, pretty much everywhere, Stitcher and iTunes and Google Play. Of course, also on my website. That's basically where people can find me.
Yeah, and I'll give you a plug. You've got a couple of really good stories in your podcast, so you do a really good job with it.
Thank you.
And so thanks again for joining us. And to our viewers, I wish you well in your journey from purchase to profits. See you next time.